So the standard finance theory believes that people are rational and they construct their portfolios. And when they construct their portfolios, they look at the mean and variance, and they decide when to invest, where to invest, how to create an optimal portfolio. And above all of that, we assume the markets are efficient. But in reality, what we see is just opposite of that. The world doesn't work in this manner in reality. Neither do all the market participants have access to perfect information, nor can they rationally process this information and make informed decisions. The fact is that the decisions made by the investors in the stock market are mainly driven by emotional factors. There are a wide variety of psychological processes as well as biases that play a very important role in our decision making. These psychological processes and biases, they play a very significant role the way we decide our investment and create portfolios. So these behavioral biases impact the financial market significantly because financial market, they function in a very different way. Predictions that we make about the future of the market actually affect the future of the financial market. This is different from other markets. For instance, a weather forecaster. Let's take the example of a weather forecaster who makes a weather prediction that it's going to rain tomorrow. Their prediction will not actually influence the outcome. The prediction itself does not cause the rain to happen. But in the case of financial market, the world functions differently. If a seasoned investor like Warren Buffett makes a prediction that the markets will fall in the future, it might spark fear among the market participants. This fear might actually spark a sell-off and the price might go low. Hence, the prediction would act as a self-fulfilling prophecy in this case. This is the reason why we need to understand behavioral finance so that you can be aware of the reasons and act prudently. So, what are behavioral biases? See, behavioral biases are the decision-making biases, and they are classified under two categories. One is cognitive bias, and the other one is emotional bias. So cognitive biases are the result of an error in the way in which we process our information, whereas emotional biases are the result of social influence and our own life experience. So there are different types of biases that we normally see when we are or in our that influences our decision making. Does that mean behavioral biases are bad? Not at all. These biases are not considered to be bad or cause irrational decisions. Psychologists believe that these biases are very important and that can help us in our adaptive purpose. Like, they will help us to take decisions quickly and we will come up with a suitable outcome. So what we need to understand is these biases are not bad. They need to be understood, avoided, or if they are good, that needs to be beneficially exploited. So there are different types of behavioral biases, like we have got a framing bias, anchoring bias, mental accounting bias, recency bias, overconfidence bias, loss aversion bias, status quo bias, regret aversion bias, etc. So in this webinar, I will be touching upon many of them, and we will, when I explain these biases, I am sure you all will be thinking like, oh, I know this, I have undergone this. So let's start with framing bias. What is framing bias? Framing bias means that the investors are more responsive to the context in which the information is presented as opposed to the content of the information. Because the investors, they react to the same information differently if it is presented in a different context. Let's take an example. Suppose I give you 1,000 BD. Then you have the following two choices to make. Your option A is you can receive another 500 BD for sure, or you can flip a fair coin. If the coin flip comes up heads, you get another 100, but if it comes up tails, you get nothing. Scenario two is you have been given 2,000 BD, then you have the following choice to make. You can lose BD 500 for sure, but if you flip a fair coin, if the coin flip comes up heads, you lose another 1,000. But if it comes up tails, you lose nothing. What were your answer? Did you choose option A in the first scenario and choose option B in the second scenario? I'm sure if you have done that, then you are guilty of framing bias. But don't worry, you are not alone. About 85% of the people who are presented with the first scenario, they chose option A. About 70% of the people who are presented with the second scenario, they chose option B. But the interesting fact is the two scenarios are actually identical. In each scenario, you end up with a BD 1,500 for sure if you pick option A. You end up with a 50-50 chance of either 1,000 or 2,000 BD if you pick option B. So you should pick the same option in both scenarios. That is which option you prefer is up to you. But the reason why people chose different option is the frame, the way the information is given in two different contexts. So the same thing happens in investment also. So in investment, depending on the context, the way the investment proposition is presented to the investors, they decide differently. So this is framing bias. I'm sure all of us must have undergone this scenario at least once in our lifetime. The second very important bias is overconfidence bias. Overconfidence bias is an illogical faith which many investors has that they have an ability to predict the market. So such investors, they believe that they are gifted and they have some special skills which will help them to predict the market. So due to the overconfidence bias, many of them, what they do, they will buy risky penny stocks and they trade too often. Both these actions are detrimental because they end up picking wrong stocks. The reason is they ignore negative information because they think that I have the investment acumen and whatever decision I make is going to be correct. Overconfidence bias is considered to be one of the most difficult biases to avoid. The reason is an investor who is suffering from overconfidence bias, he ignored the negative information because they believe that I know everything and I know what is best. So they underestimate the risk and often end up with big losses. So overconfidence bias is one of the most difficult bias to avoid. This is because whenever an investment decision is being made, investors are confident because they think that I have done enough research, so I'm sure this is the best option. However, a lot of time what has happened is this confidence may be due to a biased analysis. So from an investor's point of view, differentiating between confidence and overconfidence is impossible. That is what make overconfidence bias the most difficult one to manage. But that makes investment very interesting also. Another bias that we normally see is anchoring bias. What is anchoring? An anchoring bias is a mental flow that impacts the way the person derives the price of anything. Let's take an example. You go to a shopping mall and you see that a price of a particular product, which was for 100 BD, is now offered at a 50% discount and it is available at BD 50. So you will be so thrilled because you will think that I'm getting a 50% discount and you're going to grab that product. This is because the discount makes the product appear cheaper and its value gets increased, right? On the other hand, if the seller directly offered the product at BD 50, you wouldn't have bought it, correct? So anchoring bias causes investors to look at the past performance and assume that it will continue to remain so in the future. So to take an example, in many parts of the world, real estate is under stress and the prices have remained stagnant for some time. However, there are many investors who are anchored at the past returns, and what they think for no reason they get attached to the real estate sector because they think that the real estate sector will boom in the future. In this way, the investors are biased because they think that the past performance is going to repeat. So how can we avoid this bias? It's very important for investors to understand that they may be irrationally anchored to a price based on a biased price information. We need to be very vigilant. As investors, we need to be very vigilant, and then over time, they might make certain bad decisions financially which might impact their finance adversely. Another bias that we come across is recency bias. There is a common saying in the investment world that in the short run, the markets are like voting machines, and in the long run, they are a weighing machine. I'm sure many of you might have heard this. This saying is often said to emphasize the role of long-term investment. People with the short-term investment goals, they often fail to perform well in the stock market. Despite this knowledge, surprisingly, investors, they tend to focus a lot on the short term. So recency bias, it's a cognitive tendency of investors to focus on events that have taken place recently in the financial market. So what has happened now, that stays in our mind. So all our investment decisions are taken according to that. The biggest misuse of recency bias is done by the mutual funds and other fund managers. This is because what they do is they will show you the performance of the stocks over a couple of years. And when the stocks have done fantastically well in the market, so they will show that there is a good return is happening, and they will lure the investors. They don't give us what has happened previously, that prior to the 2 years, what has happened is not being informed to the investors. So this recency bias influences the behavior of the investors, and that needs to be understood. Otherwise, we will end up with huge losses. So we as investors need to understand that assets that have performed well in the past may perform badly in the future. So we need to understand that the past performance doesn't mean it will continue in the future too. So this makes them, so when people think that, okay, a stock has performed well in the market, so this is going to perform well in the future also. So this kind of belief make the investors vulnerable to purchase stocks at the highest peak. So those investors who suffer from the recency bias, they pay less importance to the fundamental values of the stock, and they will give a lot of importance to the recent performance alone. So what happens? They will face principal losses, and another danger of recency bias is that the investors who have recency bias, they keep all their eggs in one basket. So they don't diversify their portfolio. So all their assets will be in one asset class, which has been appreciating in the past. So this is a very dangerous strategy, and this irrational belief will lead to huge losses for the investors, and their portfolio may be damaged. Another bias that we normally see is mental accounting bias. See, it's something which we all, it's not only in investment, in our day-to-day life also, we undergo or we experience the mental accounting bias. The traditional economic theory assumes that all money is fungible. What is fungible? Fungible means interchangeable. The economic theory believes that if we have BD 100, the value is same for us regardless of how it is obtained. Does it make sense? Isn't it? The behavioral finance theory tells that this is not the case. According to behavioral finance theory, people attribute different values to the same sum of money, depending upon how it was earned. So this concept is called mental accounting. See, I'm sure all of you will agree that people tend to spend the same amount of money differently if they spend using cash or using credit cards. Correct or not? There is a psychological pain associated with giving up cash. Similarly, the risk tolerance of a person increases rapidly if they are reinvesting their earnings. For instance, if a person invests their own hard-earned money, which is, let's assume BD 10,000, then they will be very cautious of their investment. However, if that BD 10,000 has been turned into 20,000 because of capital gains, then that investor is likely to take excessive risks with the capital gains. This is because capital gains are mentally characterized as free money, because we think that, okay, this is the money that I have received. I'm ready to take high risk. I can take excessive risk. Even if I lose it, okay, it's fine. It's something that I have received free. So those who understand the influence of behavioral biases, they will not fall into this mental accounting bias. Instead, what we will do, we will evaluate each investment looking at their numerical merits. This is the reason why we need to know these biases so that we can make better financial decisions. Another bias that we see is loss aversion and regret aversion bias. The prima facie, they both will look very similar. They may sound very similar, but in reality, they are quite different. Investors who are loss averse, they do not have problems in making decisions. They just tend to make the wrong decision because of emotional factors. On the other hand, regret aversion is a paralyzing fear because as an investor, because of my fear, I cannot make any decision. So the likely outcome of loss aversion is wrong decision, whereas the likely outcome of regret aversion is no decision at all. So people with regret aversion always avoid taking any risk. So they are known for choosing the safest path. But people with the loss aversion hate losses and they may sometimes take excessive risks and end up in huge losses. Status quo bias. See, investment decision making is an overwhelming process. Like, you are, there are a lot of complexities involved in making an investment decision. So the complexities are more if you consider a lot of option and then make an informed decision. So what is the shortcut? We resort to status quo. What is status quo? In layman's language, it means an investor, when he is given with a lot of options and they are complex and confusing, he will tend to choose whichever option that extend his current arrangement. Like, what he has been doing, he will just continue that. The prime logic behind this bias is that investors are skeptical of change. People don't like change, right? So many view change as a cost and they try to avoid it as far as possible. This is the reason why they prefer the status quo when faced with an increasing number of choices. The status quo bias is closely related to other biases like loss aversion. These biases often work in tandem. This is the reason why investors, who are stick with a certain type of investment, they just continue it, even if the returns are lower because they don't want to change the status quo. So status quo bias can cause investors to hold on to certain stocks. In a lot of cases, they will become so personally attached to the investment. This most often happens in the case of real estate because they have mostly people have some memories attached to the particular property. So they are not willing to part with the property even if they get a higher price for it. So status quo bias causes investors to invest in the same type of investment avenues. How to avoid the status quo bias? See, status quo is a deeply rooted in the psyche of the person, right? It's mental related. So the best thing to do is take advice from a learned financial planner so that you can avoid this bias. Another bias that affects our investment decision making is hindsight bias. We normally hear the investors saying that hindsight is 20 on 20. So over the years, the effect of hindsight bias on the value of investors' portfolio has been significant. Hindsight bias looks at events that have occurred and believe that it was very easy to predict the cause of these events. But in reality, it's not. For instance, Many investors today, when they look at the Apple stock, they believe that it was an obvious choice 2 decades ago. However, that's not correct at all. The rise of Apple was not predictable, and it was quite possible that Apple would not have grown into the company that it has become today, but it would have instead gone bankrupt. So, hindsight bias is very tricky, and it's very difficult to avoid also. And it's not bad, it's not at all bad. It helps the humans to repeat the things that they have been rewarding in the past and avoid the ones which are painful. However, it's important to use hindsight as a guiding light only, just like, a lighthouse in the middle of the sea. If anyone thinks that hindsight is absolutely perfect and they can predict the market with absolute certainty, then they are bound to make mistakes in the long run. Another bias is illusion of control bias. The illusion of control bias is the tendency of the investors to believe that they have a certain degree of control over the market. It's very close to the overconfidence bias. Not all investors believe that they have complete control. However, a lot of them believe that they have some influence over the market. In most cases, this is not true because investment market is huge markets where trillions of dollars are transacted. Hence, if an individual investor or a small mid-sized institution, if they believe that they have a control over the market, then they are absolutely wrong. Illusion of control causes investors to take positions in the penny stocks because they think that since those organizations are small, they can use their capital to gain a significant stake in the company and control the outcome. However, a lot of these penny stocks are inherently risky because of the nature of the business they are in. So this illusion of control only causes the investors to lose more money. The first and the foremost step is to realize that when it comes to investing, there is no certainty. The profit that we earn from the investment is a reward for our risk taking. Hence, if there is no risk, then there is no reward. So nothing can be predicted. Something that we need to understand. Optimism bias. What is optimism bias? See, the gist of optimism bias is often expressed by using the popular saying, seeing the world with a rose-tinted glasses. So optimism bias, just like overconfidence bias, is closely related, but they are not the same.
Bias ko.
They are not the same. In the case of optimism bias, the investor is very hopeful that outcome of his investment will be positive and everything that happens will be in his favor. This may attribute to luck or a general sense of well-being. It is different from overconfidence bias because in overconfidence bias, the investor thinks that I have a superhuman power and I have the best investment acumen and whatever I predict is going to happen. Thus, these are the most common biases that we normally see under the behavioral finance. So the discussion that we had clearly shows that knowledge of these biases help us to trade in the market. This branch of finance, that is behavioral finance, has become exceedingly popular in the past few years. This is because of the fact that it mixes the dry numerical subject of finance with an interesting world of psychology. I'm sure most of you who listen to these biases must be having a Me Too moment, right? You must be thinking, oh, this has happened with me. The biases are quite relatable, and most investors, we have been victims of these biases at one point in time or the other. That's the reason why investors are often easily convinced about effectiveness of these biases. There are many investors who swear by its efficiency, and they all think that knowledge of these behavioral biases have helped us and protected us from many losses. The reason why behavioral finance and these behavioral biases have gained a lot of attention is their ability to explain how the market works. It offers some sense of control in a world which is completely volatile, and the the behavioral finance also shows us the real mirror of the world, that the world is not perfect and not all investors are rational. So as an investor, it's very important for us to know and understand these flaws and before we make an investment decision making. Does that mean behavioral finance is a perfect science? Not at all. It has many limitations. The major criticisms which are leveled against behavioral finance is that it drastically reduces the investor's confidence. See, after being equipped with these theories, what happens? Many investors, they lose their confidence. They feel that, I can't make any decision. I don't know whether this is a bias. So this is because the investors start guessing their own abilities. So everything they used to believe earlier now starts looking like a bias. So behavioral finance views emotions as biases. So in other words, it views emotions as cognitive problems that need to be fixed over the long term. In reality, that's not the case. Emotions have been friends of the human beings for a very long time. So emotions guide us from chaos and dangers. So they can be very useful. So investors should realize that they don't have to abandon these emotions. So what we should do is we need to optimize our emotions, and we should take our final decision in a cool and a rational manner. So many believe in behavioral finance is less about finance and more about psychology. So they feel that it's difficult to apply it in the investment decision making, but that's not true. A good understanding of emotional biases or behavioral biases will help us to make a rational decision when it comes to investment. So what are the lessons we learned today in the behavioral finance? The lesson one is investing is an emotional process. Lesson two, trend may not be your friend. Lesson three, biases can never be eliminated. It will be a part of your decision making. Lesson four, context is important. Definitely. Lesson five, suboptimal. Don't always look for optimal decisions. Suboptimal may be optimal. So some conclusionary remarks. Please understand behavioral finance not only impact the individuals, it's also for the institutions. Is it a perfect science? Not at all. It looks at the real world as imperfect and individuals as irrational, which we are. Yes, behavioral finance focus too much on psychology. So the right mix of behavioral finance with the traditional finance will help us to make a appropriate decision making. Is it limited to certain asset classes? Not at all. The rule is applicable to all the asset classes, even to alternatives. Is it without shortfalls? Not at all. We discuss some of the problems of behavioral finance. So I hope by listening to and understanding these behavioral biases, when you make your investment decisions in the future, it will be a little bit different than how it used to be. Thank you. If you have any questions, I'm more than happy to answer. Thank you all for your presence. And if you have any questions, you can email to chitra@bivf.com. We are here to help you. Thank you.
Thank you.